The PGBP starts with a section called as section 28, which comes and talks about charging section. From exam perspective, charging section is not very important. The only thing which you need to remember is any kind of income which is revenue in nature and it is pertaining to the business should be taxed under PGBP. There are some additional items which they have given as an extra deemed income. What are the items, Rahul? Some of the items which are there is any kind of benefits or perquisites which are given to an person during the course of business, whether it is convertible in money or not, whether it is in cash, whether it is in kind or part cash and part kind. Current year amendment, so important for exam. Next we come and say any kind of termination or modification of any kind of contract which is relating to business, whether it is revenue or it is capital, doesn't matter, it is taxable. Then we come and say any kind of indirect tax benefits, like if you are giving any import entitlement license, any kind of duty drawback, cash assistance, anything of those items also become taxable. Any kind of salary or remuneration which is received by a partner from a partnership firm will be taxable under this head. Where we'll discuss in assessment of firms. And then we are saying any other payments like non-compete fees and all those things are also taxable under this head. There are some case laws for you to remember. Case law number 1, I am coming and saying if you are in the business of letting out of your properties and your majority of the income is coming from that business, then in that case it is taxable under PGBP and not under IFRS. Next, I'm coming and saying that if you had to deposit any money with the bank, if you had to deposit any money in the bank for you to get bank guarantee, this bank guarantee was given for the business, so the money deposit was also done for the business. The interest income coming from this money will be assumed to be PGBP and not IFRS because it is linked to the deposit. Next, I'm coming and saying that if at all government is giving you any subsidy, instead of giving you cash in hand, they have given you a bond. The bond is sold and you have incurred loss on it. That loss will not be called as a capital gains loss. It will be called as a business loss. The reason is because subsidy was taxable under PGBP. So loss should also be claimed under PGBP. Yes. Next, I came and told you that if you are having any business, you have to split your business into two. One is normal business, one is speculative business. Speculative businesses are those businesses which are done without actual delivery. Hey, risk of loss is high or low? Risk of loss is high. If the risk of loss is high, losses are more. Income tax comes and says if you have any speculative loss, it should be set off only against speculative income. If you do not have any speculative income, you will carry forward and set off only against speculative income for a period of 4 years. Return filing on time is mandatory. What are items which are speculative income, Rahul? Any items where there is no delivery. But what are the items which are not speculative income, Rahul? It can be hedging contracts, forward contracts, any kind of derivative transactions, any kind of transactions on which you pay securities transaction tax, and any kind of commodity transactions on which you pay commodities transaction tax, except for agricultural commodities where you do not have to pay CTT. This is what your basics said. Then we came and we discussed what happens in PGBP. We came and said format is net profit, add disallowances, add addition, less allowances, less addition. We started with the deductions part and we came and said any kind of expenditure which you incur in a plant and machinery or a building, whether it is rent, rates or any kind of taxes, everything is allowed as a deduction except for repairs. Repairs, if it is current repairs, allowed as a deduction. If it is capital repairs, capitalize and claim depreciation, even if you are not the owner of the asset. At any point, if you are using this building part for business and part for personal, expenses to the extent of personal will be disallowed. Then comes the most important section from exam perspective called as depreciation. Income tax comes and says whenever you are charging depreciation should be as per income tax, should not be as per books of accounts, which means any depreciation as per books of accounts should be disallowed. You need to come back to income tax. Income tax comes and says you need to follow certain rules. Rule number 1, it should be your asset. Second, it should be put to use. If you are putting to use, then it is allowed as depreciation from the date on which you first put to use. But if at all you have a passive use asset like fire extinguisher, machinery spares or any kind of safety equipments and all those things, those are allowed depreciation from the date on which it is ready to use. You can also claim depreciation. You cannot claim depreciation on land and goodwill. If you want to do depreciation, income tax says you have two methods of depreciation. One is called as SLM method, one is called as WDV method. SLM method is only for power sector. WDV method is for all assessees including power sector. The rules come and say that if you want to do depreciation, you need to come and do depreciation as per income tax. as per income tax, which means you need to know the rate of depreciation. You need to know the rate of depreciation. Rate of depreciation from exam perspective, building is 10, furniture is 10, temporary building is 40, residential building is 5, any kind of plant and machinery 15, any kind of motor vehicles 15, any kind of hired motor vehicles 30, any kind of computers 40, computer software 40, case law, laptops, any kind of printers and scanners 40, any kind of mobile phones, plant and machinery 15, EPABX, plant and machinery 15, any kind of intangible assets 25, any kind of aeroplanes 40, books 40, annual publications 40, ships 20. This is what the rates of depreciation are. But income tax comes and says, if you are planning to put the asset to use for less than 180 days, depreciation rate will become half for the first year. Depreciation rate will become half for the first year. So first year you will check for less than 180 or more than 180. If it is less than 180, then it is 50% of the rate given. If it is more than 180, then it is 100% of the rate given. If you have not even put to use, it will be 0 for the current year. Now notice very carefully, if you have not put it to use in the current year, but in the next year you are putting it to use even for less than 180 days, you will still get depreciation at 100% because the asset is already a part of your opening WDV. So even if you have taken an asset which is put to use for less than 180 days in the next year, it will still be eligible for full depreciation because you bought it in the earlier year. Yes or no? Yes. Then I'm coming and saying, Rahul, how to do the SLM method and all. SLM method, you can do normal accounts. But in case you do SLM method, you need to maintain assets individually. If you end up having a sale, in the sale if you do a loss, whatever loss you have can be claimed as a reduction as terminal depreciation. If you end up having a profit, you can claim you have to offer the profit to tax to the extent of the cost. Anything beyond the cost will go to capital gains. Yes or no? If you are doing WDV method, Rahul, WDV method has to do in a block of assets concept, which means once you have an asset, you put it into the block, it becomes a block. After that, I do not even look at the asset. I don't look at the characteristics of the assets also. Block means any kind of block where the nature is the same and the rate is the same. What is the format, Rahul? You start from opening WDV, add additions, less sale value, arrive at gross cost. On that, you will do depreciation to arrive at your closing WDV. Opening WDV means WDV of last year. Additions means any kind of expenses which you have incurred for the purpose of making the asset ready for put to use. Expenses can be purchase charges, installation charges, any kind of ITC not allowable, any kind of carriage inwards, any kind of trial run cost, interest cost up to the date on which the asset is put to use, any kind of exchange fluctuations which we discussed, 43A. Any kind of exchange fluctuations, if you are going to make a payment on a subsequent date, less any kind of sale value of the trial run products, less any kind of subsidy which you received from government specifically for the asset. Exception here is if you have made any payment for this asset more than 10,000 to one person in one day other than by permissible modes, the payment will be ignored. No depreciation will be allowed. Then some special scenarios are there. Special scenarios come and say, if at all you have bought an asset with sole intention to avoid taxes, assessing officer will recompute your asset. If you have bought an asset, transferred it to someone and then got it back, the WDV in your books or the actual receipt value, whichever is lower, will be taken. If you have given it to someone and taken it back on lease, the new owner will have the same WDV as the old owner. If you have building which you have used for personal purpose and then brought into business, you take the building assuming it was always there in the business. Compute notional depreciation, ignore that much of depreciation, balance will become your capital building in the books. Note very carefully that if it is any other asset, it will be brought at the same actual cost. Unless and until you are a non-resident. If you are a non-resident, whatever assets you use in India now, again you will do a notional depreciation and then balance will what you will claim as a asset in your books for the purpose of depreciation. Balance items are not important. After you had additions, you told sale value. understand very carefully. Under income tax, the only item which can be reduced is the sale value. You cannot write off an asset, you cannot discard an asset, you cannot move out an asset. You can only claim sale value. If you have a rupee, you put the rupee. If you don't have a rupee, leave it off. Leave it off. Don't put anything else. Don't put anything else. The moment you have considered the sale value in the block, any profit on sale of asset or loss on sale of asset which is there in accounts will be removed from the P&L. Will be removed from the P&L. Remember, the only item which you can remove is the actual sale value. Actual sale value. Then you will do your depreciation. I told you depreciation you have to do as per the block concept, which means more than 180, less than 180. If more than 180 it is 100% rate, less than 180 it is 50% rate. Not even put to use, no depreciation in the current year. No depreciation in the current year. After you do depreciation, you also have this one concept called as additional depreciation, where income tax comes and says that if at all you are having a manufacturing sector, what do you have? You have a manufacturing sector who is following WDV method, or you are into power sector, In that case, you are eligible for additional depreciation at the rate of 20% of the new plant and machinery, or 10% in year 1 and 10% in year 2 if the asset is put to use for less than 180 days. What is new plant and machinery, Rahul? It means all plant and machinery excluding any second-hand machinery which is used either in India or used outside India. Then any kind of machinery which is installed in office premises, any kind of machinery which is in the nature of office appliances, any kind of machinery which is in the nature of ships or motor vehicles, except for forklift are eligible, and then any kind of assets on which you can claim 100% deductions. These assets are not eligible for additional depreciation. Notice carefully, additional depreciation can only be claimed in year 1, the moment the asset is new. Next year, when it goes to the block, you are no further eligible for additional depreciation. The only thing which you can get in year 2 is 10% of last year, provided it is put to use for less than 180 days. Yes or no? Yes. Then I'm coming and saying, Rahul, if you want to claim any depreciation, in case you are having an asset which you are going to give to someone else, because of amalgamation, demerger or business reorganization. Income tax is saying, do one thing, boss. You compute the depreciation for the whole year. Then come and check how many days did the one person utilize and how much days did the other person utilize. Depending on the number of days, you apportion it off. It is there on the book. You can see the example. Then I'm coming and saying, Rahul, if you're going to use one asset for both agriculture and business, compute depreciation for the whole asset assuming it is business. That same depreciation value is what you'll reduce from the block also. Don't split and reduce lower number. You'll reduce the whole number. Then I'm coming and saying that, Rahul, if you have completed depreciation, you have to go back to closing WDV. Income tax comes and says that, Rahul, what to be reduced from closing WDV is the actual depreciation which you claimed. Which means if you have an asset which is used both for personal purpose and for business purpose, to the extent of the personal purpose, depreciation is not allowed. Which means when you reduce it from the block also, you will only reduce the actual business depreciation. You will not reduce the personal depreciation. Then income tax is coming and saying, boss, if you want to claim depreciation, it is mandatory to claim for everyone. In case of lease and all, only lessor can claim depreciation. In case of hire purchase, the purchaser will claim depreciation even from day one. For you to claim depreciation, it is not required that you need to have the name in your title. Even if the name is in name of someone else, but you are having the actual right and ownership, you are still eligible, called as ICDS. Then they're coming and saying, if at all you want to claim any kind of assets under capital gains, then you need to close the block. How will we close the block? Capital gains chapter. This is what is your whole depreciation. If at all you do your depreciation and you end up in a Pgbp loss in the current year, income tax comes and says, to the extent the Pgbp loss pertains to depreciation, that will become unabsorbed depreciation, which will be carried forward for infinite years. Due date for return filing not required. Can be set off against any head other than salaries. Yes or no? Yes. This is your first important section called as section 32. Can we go forward? Yes. Next section is called as tea, coffee, rubber development account, or site restoration fund, If you are into the business of developing tea, coffee, or rubber, or into the business of extracting petroleum or natural gas, for which you need to do site restoration, if you create a special account in your books, the account is called as tea, coffee, rubber development account, or it is called as site restoration fund account. If you create a special account in your books and you deposit money in this, under tea, coffee, and rubber development, you will get 40% of the amount, 40% of the Pgbp as a deduction. You will get the 40% of the Pgbp as a deduction, subject to the condition that you deposit the money in the books. In that special account. So which means, in simple words, you can claim deduction of actual amount deposited in the account or 40% of the Pgbp, whichever is lower. If you are in site restoration fund, it is actual amount deposited or 20% of the Pgbp, whichever is lower. This is what the provisions come and say. Now, whatever money you are depositing in the account should be used only for the purpose given by the act. Or you can buy assets against it. But the assets which you buy against it should not be bought for installation in office. Should not be bought for office appliances. Should not be bought as a vehicle and all those things. Should not be bought for hazardous products. Those things will become a violation. If at all you want to buy anything for office, the only thing which you can buy for office is computers. Computers can be bought for office. It will still be called as eligible. So use the money only for the purposes given by them, or use the money for buying assets which are used in your manufacturing operations. Whatever assets you bought will not be eligible for depreciation. Whatever assets you bought, you should hold it for at least 8 years. If you withdraw the money within 8 years, or you sell the asset off within 8 years, whatever withdrawal happens or whatever sale happens, the deduction will be taxable. Whenever you are doing this thing, Rahul, ensure that this deduction will come before you do the 40-60 split in agriculture income. And before you do any kind of loss set off. It happens all before, which means you will first give the deduction, then you will do the 40-60 split, then you will claim losses. This is what the sequence is. If you plan to withdraw money from this fund, you can withdraw this money only for tea, coffee, and rubber development account. That also, in case it is done by extraordinary scenarios like closure of like death of the assessee, partition of HF, or liquidation cases. Otherwise, it will become taxable in the year of withdrawal. This is your 33. Moving on to 35, scientific research. In a single nutshell, scientific research comes and says that in case you have any scientific research, the whole of the expense will be allowed as a deduction, whether you do in-house or you do contributions. The whole of the expense will be allowed as a deduction except for land. If you have any kind of scientific research losses will be treated same as unabsorbed depreciation. If you plan to sell your scientific research assets, you need to ensure that you sell the assets only to your internal business. If you give it to your internal business, the block will have a value of 0. But if you plan to sell it off directly in the market, whatever deduction you claimed will be treated as income to the extent of the profit. If you end up selling it beyond your cost also, the difference will go to capital gains. Then we came and said any kind of agriculture extension project or skill development project, again 100% is allowed as a deduction except for land and building both. Agriculture extension is there only for all assessees, whereas skill development is there only for manufacturing assessees. Next 100% deduction is 35AD, which is your specified businesses. I told you some important ones. Hospital with 100 beds, hotels with 2-star, warehousing facility for sugar and agricultural produce does not consider edible oil. All these cases, revenue expenditure is fully allowed as deduction. Capital expenditure is also fully allowed as deduction as long as it is capitalized in the books. 100% of it is allowed as deduction except for land. If you want to make a payment, please make sure that you make the payment by permissible modes more than 10,000 to single person in single day. Using 35AD is an optional scheme. It is not mandatory scheme. They are saying if you incur any losses from the specified business, this losses from specified business can only be set off against income from specified businesses for infinite years. For infinite years, return filing on time is mandatory. Return filing on time is mandatory. Understand, when you try to set it off against your specified business income, it is not necessary that the specified business income should have been claiming 35 AD. As long as it is a specified business, you are eligible for deduction. You are eligible for deduction. Yes or no? Yes. These are all your items which are eligible for 100% deduction. These are all the items which are eligible for 100% deduction. Income tax comes and says that if at all you want to sell the specified business assets, you have two options. You can either sell it directly to the market or you can bring it to your business. If you sell it directly in the market, same as 35, you will offer the profit to tax to the extent of cost. Balance will go to capital gains. If you plan to sell it to your business, please sell it to your own business after 8 years. After 8 years, if you sell it within 8 years, I will assume that the asset was always a normal asset, which means I will compute depreciation from year 1 till the date of sale, and that income I will leave it off. Balance everything I will offer to tax, and I will add it to the cost of the asset. If at all you sell it after 8 years, then there is no problem. Nothing will be offered to tax. Nothing will be added to the cost also. Case law here in CBROS come and say that if at all you are trying to claim 35 AD, you are eligible to claim 35 AD the day on which you started your business. In case assessing officer is delaying your approval, that should not withdraw your claim. You can still continue to claim. Even if the assessing officer is delaying the approvals. Yes or no? Yes. This was all your 100% deduction expenses claim. Next is your life of the asset claim. Where we are discussing about license fee and spectrum fee. Income tax comes and says, if at all you have payments made for any license fee and spectrum fee, do not consider them as a capital asset for depreciation. For the year for which the license is available, amortize the expense of. If you have paid this expense even before you business had started, you can claim the expense from the day on which the business is started. So in simple words, the claim will happen from the day of starting the business or date of payment, whichever is later. Understand, you cannot claim this expense on an accrual basis. If you make the payment, you get the claim. You don't make the payment, no claim for you. The claim will come only from the date on which you make the payment. Both the rules, same logic. Next, they are coming and saying, Rahul, if you plan to sell these assets, what are you planning to do? You're planning to sell these assets. Check whether you are selling the whole of the asset or you're selling part of the asset. If you're selling whole of the asset, method is same as SLM basis. If you're planning to sell part of the asset, if you sell it for loss, the unamortized portion will continue to claim deduction. Which means whatever is left in the block, that block you will continue to claim deduction. Balance items you will write off. But if you end up selling it for profit, provisions are same as SLM basis. Yes or no? Then I'm coming and saying any kind of zero coupon bonds. Also I'm coming and saying the zero coupon bonds, whatever is your loss which you're going to make from zero coupon bonds should be amortized over the number of months. That was number of years. This is number of months. This is your expenditures which are amortized over life of the asset. Next are all your expenditures which are amortized over 5 years. Next are all the expenses which are amortized over 5 years. Income tax is coming and saying that if at all you have any preliminary expenses, you can amortize the preliminary expenses over the period of 5 years. The rule for preliminary expenses is that if you are an Indian company, you can claim 5% of the cost of the project or 5% of capital employed, whichever is lower, versus the actual expenditure, 5% of the cost of the project or 5% of capital employed, whichever is higher, compared with your actual cost, whichever is lower. What is cost of the project, Rahul? Expenses incurred for assets. What is capital employed, Rahul? Any kind of shareholder funds plus long-term debts. But you will not include any securities premium. Which means it is only share capital plus long-term debts. This is your first expense. What is the expense? Preliminary expenses. Second expense is called as any kind of amalgamation and demerger expenses allowed over a period of 5 years to the new company. Then I'm coming and saying any kind of expenses for voluntary retirement scheme, again allowed over a period of 5 years. Then I'm saying any kind of family planning, revenue expenses allowed this year itself, capital expense allowed over a period of 5 years. So 4 expenses we learned from 5 years logic. 4 expenses we learned from 5 years logic. Section 35E you can ignore from exam perspective, not so important. Just to hindsight, if you are into minerals and extraction oils and all, then in that case the period is 10 years. Whatever expenses you incur, you can amortize it over 10 years. Then any kind of interest on borrowed capital. Income tax is saying that if you are going to pay interest on your loan, ask me whether the loan is for working capital or assets. If it is for working capital, fully allowed as deduction subject to 43B. If it is for assets, in that case I will ask you, has the asset been put to use? If you say yes Rahul, the asset has been put to use, I will say allowed as a deduction subject to 43B. If you say no Rahul, asset has not been put to use, I will come and say to the date on which the asset is put to use, till that date you will capitalize. Understand, if you are going to capitalize something, I don't care whether the interest is paid or outstanding. You will capitalize and claim depreciation. The conditions to payment is only in revenue, which is only in 43B. If you have taken this loan for personal purpose, obviously 100% disallowed. Then I am coming and saying, if you have any welfare of funds, if you make employer's contribution to a fund, make sure that you make the payment by 43B. If you make the payment under 43B, which means within the due date of return filing, you will get the deduction in the current year itself. If you don't make the payment within the due date of return filing, you will get no deduction in the current year. You will get the deduction in the year in which you make the payment. I am saying no Rahul, it is not employer contribution, it is employee's contribution. Income tax says if it is employee's contribution, make sure that you make the payment within the due date of the respective act. If you have collected money from employee and made the payment within the due date of respective act, you will get no challenges. There will be no tax implications. But if you take the money from the employee and you don't make the payment within the due date of the respective act, the day on which you make the delay, that day it will become a permanent addition with no further claims. It will become a permanent income. Yes or no? Yes. Next time coming and saying bad debts. Income tax is coming and saying if you want to claim bad debts, follow your accounts properly. In accounts we do first offering the income. So rule number 1, offer the income. Rule number 2, write off the debt. If you do both the conditions, you will get the bad debts claim. It is not mandatory for you to prove that the debt is bad. It is enough that you write it off. If you have any bad debts claim, the year in which you get the recovery, in that year you can offer it to tax even if you don't have a business. In case the assessing officer had disallowed some bad debts in the earlier years. In that case, whatever he disallowed in earlier years will be reduced in the current year on recovery. That is what the rule is. The rules. Next is coming of provision for bad debts. I came and told you provision for bad debts is only applicable for banks. Yes, income tax comes and says if you are an Indian bank or a cooperative bank, you can claim 5% of your GTI as provision for bad debts. Add another 10% in case you are having any rural advances. If you are any foreign bank, NBFCs, public financial institutions, state finance corporation and all those things, you will get, Indian banks is 8.5%. Plus 10%. If it is a foreign bank, it is 5%. If you have any kind of bad debts arising, first set it off against the old provision, then only claim the current year. Yes or no? Yes. Next time coming and saying that if you have any other deductions, these deductions can be ignored. Will be fully allowed as deduction. Example, insurance premium, loss of cattle, STT paid, CTT paid, bonus paid, commission paid, all those items. Then you have some items in the middle called as amount to transfer to special reserve for banking and financial corporation. You can transfer money in that and claim 20% deduction. But the year in which this fund goes beyond twice your share capital in reserves, that day deduction will stop. Next time coming and saying if you have not to put your expenses in some other head, come and look for me in 37. In 37, follow certain rules. Rule number 1, it should be your expense. Rule number 2, it should be for your business. Rule number 3, it should be not capital. Rule number 4, it should not be not personal. Rule number 5, it should be not an offense payment. Offense payment under a law. This is what the rules come and say. Which means if you have any donations disallowed, CSR expense disallowed. Key man insurance, allowed. Any kind of gifts given to doctors and patients, disallowed. Any kind of recommendations given to a clinic, disallowed. All are illegal payments. Any kind of interest paid to MSME, disallowed. Disallowed. Any kind of donations given to political parties, disallowed. Electoral trust, also disallowed. Also disallowed. All these expenses will get disallowed. If you have any kind of interest or penalty payment, interest under any other law is allowed. Interest under Income Tax Act is disallowed under 48(2). Penalties under any law is disallowed. Late filing fees is generally allowable, but if it is a late filing fee pertaining to return filing of income tax, if it is a late filing fee pertaining to return filing of income tax, then it is disallowed as per ICA recommendations. As per ICA recommendations. Then I'm coming and saying, if you have any kind of issue or collection expenses, ask yourself whether the issue or collection is going to increase your capital base or not going to increase your capital base. If it is not going to increase your capital base, for example, it is for debentures or buyback or bonus, then in that case it is a revenue expense, you can claim as deduction. But if it is going to increase your capital base, for example, it is IPO, FPO or right shares, then it is disallowed because it is capital expense. It doesn't matter even if the IPO does not get materialized. It does not matter even if the IPO does not get materialized, it will still be a capital expense. It will still be a capital expense. In the case laws, I'm coming and telling that if you have incurred any expenditure for glow sign boards, it is treated as a revenue expense because it does not give a future economic benefits. The life is very small and the payments are very recurring. If you have incurred any feasibility study report for doing a project, but the project got abandoned, the expense can be claimed as a deduction because of Priya Village roadshows. But yes, if you are going to incorporate a new business altogether, then in that case it will be disallowed because there is a ICI decision of McGrath. New business fully disallowed, existing business allowed. Then I'm coming and saying, if a lawyer comes and asks for a heart surgery expense to be treated as a revenue expense in books, you will say it is not allowed because it is not an asset. And it does not give any future economic benefits. Last I'm coming and saying, if you are going to make any payments to police or gundas for keeping your cinema theater safe, then in that case those expenses are called illegal expenses or illegal gratification. Even though it is for safeguarding your business, it is illegal in nature and therefore it will be disallowed. These are all your expenses for deduction purposes. Moving on to the next one called as disallowances. Income tax comes and says, if you have any disallowances can be in the nature of tedious defaults. Income tax says, if you are going to make payment to someone and the payment is liable for TDS, please do two things. One, deduct the expenditure before the previous year. Condition number two, whatever expenses you deducted, whatever TDS you deducted, please make sure that you make the payment before the due date of return filing. If you follow both the conditions, expense will be allowed in the year of accrual. If you don't follow any of the condition, if you have deducted after the previous year or you deducted and did not deposit within the due date of return filing, the expense will be disallowed 100% in case payment is to non-resident, 30% in case the payment is to a resident, and will be allowed only in the year in which you pay the TDS. I'm giving you an alternate option. Alternate option comes and says, if the other person, whether it's a resident or a non-resident, files a return in India, shows the income in that return, pays taxes on that income and gives me a CA certificate, in that case you can claim the expense in the year in which the return is filed by the other person. Case laws come and say that if you want to make a disallowance will happen on both payments, whether the payment is paid in the current year or it is payable in the current year. It doesn't matter. Even if the expense is payable in the current year, it is disallowed. Even if the expense is fully paid in the current year, also it is disallowed. Second, they're coming and saying, Rahul, if you feel that the expense is not liable for TDS, you will not attract a disallowance. Assessing officer cannot come and request you to make an application every single time for it, as long as you are confident. Next, I'm coming and saying that, Rahul, if you're going to incur any expenses which are in the nature of taxes paid under Income Tax Act, whether it is a tax, cess, surcharge or any interest, it will be disallowed under income tax. These payments, if it is for any other law, it is allowed as a deduction. If you are going to have any interest on TDS, that is also disallowed under Income Tax Act. Then I'm coming and saying that if you are going to make any salary payments to a non-resident, please make sure that you make the salary payments to a non-resident after deducting TDS. If you do not deduct TDS, 100% of the expense will be disallowed. Then I'm coming and saying that if you're planning to give any non-monetary perquisites to your employees, what are you doing? Non-monetary perquisites to your employees. If you are ready to bear the tax on it, employee will get an exemption, but you will take a disallowance permanently. Then I'm coming and saying that if you are going to make a payment to your specified persons, if the payment is found to be excessive or unreasonable, the payment will be disallowed. Who are specified persons, Rahul? For an individual, it is the left side of the family, which means spouse, siblings, parents, child, grandparents, grandchild, lineal ascendants, lineal descendants. Yes. And any other concern in which the person has a substantial interest along with his relatives. But for example comes companies. Puerto Rico, the specified persons are shareholders having more than 20% holding, directors of the company, relatives of these directors, relatives of these shareholders, any concern in which these directors or shareholders have interest. Along with my fellow subsidiary, my parent company, my associate company, all those are also covered. Please understand, in this section, what can be disallowed is only expenses. You cannot disallow any incomes. You cannot add back any incomes also. And the payment should only be made to specified persons. Even if it is made to unspecified persons which are unreasonable, it is still allowed as deduction. Moving on to the next section, which is 48.3. 48.3 comes and says that if you are planning to make any payment, the payment should happen by permissible modes. If you make the payment more than 10,000 by other than account pay check, other than account pay draft, other than electronic clearing system, or other than by prescribed modes to a single person in a single day, the payment will be disallowed. If you have booked the payment in the earlier years, but you are making the payment in the current year, I will deem it as income. What is this permissible modes, Rahul? Debit card, credit card, NEFT, IMPS, RTGS, UPI, Beam Aadhaar Pay, all those are specified modes. Understand, bearer check and cross check is disallowed. If you are going to make a payment, the payment is happening to transport operators, 10,000 will become 35,000. If you have to make the payment to some exceptional cases, I will give you the deductions. Exceptions are, in case you are making the payment to RBI, SBI or cooperative banks, not covering private banks. If you're planning to make a payment by netting of dues, you have some receivables, you have some payables, you're netting it off, that is also permitted. Then I'm saying if you're going to make a payment to any farmers, cultivators, agriculturists and all those things for agricultural produce, don't make the payment to tradesmen or middlemen or brokers, that will be disallowed. Then I'm making a payment in case of a town or village where there is no banking facility. I'm saying I'm going to make a payment for my employees for his retirement benefits. You can make the payment in cash up to 50,000 rupees. Then I'm saying I'm going to make a payment to my employee because the employee is being transferred somewhere else. I'm saying you can make the payment to the employee provided the transfer is for at least 15 days and the employee does not have a bank account there. Yes. Next, I'm coming and saying, Rahul, if you want to create a provision for gratuity will be disallowed. And will be allowed only in the year of actual payment of gratuity. But yes, if you are planning to make a gratuity fund which is approved, if you make the payment to the gratuity fund within the due date of return filing, then you can claim the deduction. 43A we already discussed. I came and told you, if you have bought an foreign asset, on credit basis, or you have taken a foreign loan against it, whatever loss which you are going to incur on ultimate payment, should be added to the cost of the asset, should not be claimed as a revenue expense. If you are going to incur a foreign exchange gain, you can reduce it from the cost of the asset, but you should never offer it to tax. Okay, so any foreign exchange gain or loss arising from a foreign asset for which payment is happening on a subsequent date, the gain or loss will be considered as capital nature. Apart from this, if you have any other losses, all the losses can be claimed as deduction, same as ICDS 6 or accounting standards. Then I'm coming and saying that Rahul, if you are planning to make a payment to some specified people, if you're planning to make a payment to specified people, what payments, Rahul? I'm telling that if you're going to make a payment of tax to government along with cess or fees or interest or whatever it is, I'm planning to make any contribution to employer for provident fund or any other fund. I'm planning to give employee any bonus or commission. I'm planning to give employee any leave encashment. I'm planning to give banks any interest on loan, or NBFCs or state financial corporations, public financial corporations, cooperative banks and all those things. What NBFCs, Rahul? Top, middle and upper layer NBFCs. All these people, if you make the payment within the due date of return filing, you will get the deduction in the year of accrual. You don't make the payment within the due date of return filing, the payment will be disallowed. Allowed in the year of actual payment. Allowed in the year of actual payment. Amendment for the current year. If you have an MSME, please make the payment to the MSME within the due date as per the contract. If contract has a due date more than 45 days, I will assume 45 days. I'll assume 45 days. If the contract does not even have a due date, make the payment within 15 days. Make the payment within 15 days. If you don't satisfy these conditions, the payment will be disallowed immediately on the next day. No due date of return filing and all, as per the contract. The due date, the payment will be disallowed and allowed only in the year of actual payment. If you have an interest to be paid, and you have converted this interest into a loan, debenture or any other form of debt, you will not get the deduction on conversion. You will get the deduction on ultimate payment of the loan. Yes or no? Yes. After 43B, we completed what is called as Pgbp. Some special provisions on the bottom. I came and told you, if you have any construction contracts, we will discuss it as per ICDS. If you have any kind of NPS the interest will only be allowed as will only be required to be offered to tax as per RBI guidelines or as per actual receipt, whichever is earlier. Generally, it will only be actual receipt. So in simple words, interest on NPS should be offered to tax in the year of actual receipt. If you are planning to convert, amalgamate, demerger, business reorganize and all, whatever stock in trade which you have, stock in trade will be transferred to the new owner at the same cost at which I bought it. So cost to the new owner will be cost to the previous owner. If you have any kind of cooperative banks and all, which is getting reorganized because of amalgamation, demerger and all, any long-term expenses like preliminary and all those things which are amortized over multiple years, the new company can also continue to claim it as long as he satisfies the conditions. Then I came and said you, in case you are completing Pgbp, you have some admin provisions. Admin provisions come and say maintaining books of accounts. If you are into business, please maintain books of accounts if your turnover is more than 10 lakhs and Pgbp is more than 1,20,000 in any of the last 3 years, or you're expecting it to happen in the current year. If you're expecting it to happen in the current year, please maintain books of accounts as per your wish to ensure that the assessing officer can compute your tax. If you are telling no, Rahul, it is not satisfying these conditions, I will say don't maintain books of accounts. If you are into profession, I will come and say, Rahul, tell me whether your gross receipts is more than 1,15,000 all the 3 years. If it is more than 1,15,000 all the 3 years, or you're expecting it to go more than 1,50,000 in the current year, in that case, you need to maintain books of accounts, which income tax will come and tell you. What are professions, Rahul? Legal, medical, engineering, CAs, accountants, CS, technical consultancies, film artists, all those people. What books are prescribed, Rahul? Cash book, journal, ledger, then any kind of bills which you give, bills which you have, any kind of daily case register or inventory logbook in case of a medical profession. I am saying, Rahul, no, I am a notified professional, but I am not satisfying the limits. Income tax says no problem, still maintain books of accounts. Don't maintain it as per my recommendation, but do it as per your wish. Do it as per your books. If you are going to maintain books of accounts, you need to maintain books of accounts for at least 6 years from the end of the assessment year. If you fail to maintain books of accounts, you will be liable for 25,000 of penalty. Tax audit will be discussed when we do tax audit chapter. So ignoring that, moving on to presumptive taxation. Income tax comes and says that if you are a resident individual, HUF or firm not being an LLP, in that case you can choose for presumptive taxations. Rules in the current year come and say, if you are a digital business, meaning your receipts are coming more than 95% in permissible modes, limit is 3 crores. If it is not, then it is 2 crores. You will be eligible for presumptive taxation of 8% on all turnover, 6% on turnover in case the turnover is received by permissible modes and it is received before the due date of return filing. If you opt for presumptive taxation, you don't have to do Pgbp income. All adjustments are taken care of. Depreciation is assumed to be granted. Unabsorbed depreciation is assumed to be adjusted, and no further adjustments are required. No further adjustments are required. If you opt for presumptive taxation, you don't have to pay advance tax all 4 quarters. You can pay advance tax only in the last quarter. If you want your due date of return filing becomes 31st July, you don't have to maintain books of accounts. You don't have to get them audited. But if you choose to come out of presumptive, you will have to maintain books of accounts. You will have to get them audited, and you will have to compute the income as per Pgbp. Yes, if you are in presumptive income of business, you need to be in presumptive income of business for 5 years. If you choose to come out of presumptive in any of these 5 years, from that year to the next 5 years, it will become normal business. It will become normal business. Next time, going to presumptive of profession, income tax comes and says that if you are a resident individual, HUF or firm, not being an LLP, if your gross receipts are less than 50 lakhs, or if you are in a digital business having turnover more than 95% received in permissible modes, gross receipts is 75 lakhs, you will be called as a presumptive person. In that presumptive, you need to offer 50% of your receipts as income. If you do that, all conditions same as business except for the 5 years. Except for the 5 years. Last presumptive, I am coming and telling you are in a transport operation having less than, having not more than 10 vehicles at any time in the previous year. Split your vehicles into two. One is called as heavy good vehicles, one is called as light good vehicles. Heavy good vehicles, it is 1000 per ton per month or part thereof per vehicle, or part thereof per vehicle. If it is any other vehicles, it is 7500 per month, part thereof per vehicle. Understand, this computation will happen on an ownership basis and will not happen on put to use basis. If you satisfy all these conditions, provisions are same as business and profession with only one exception. The exception is advance tax now has to be paid for 4 quarters. Advance tax has to be paid for 4 quarters. With this, your Pgbp is over.